Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good.
Doing well, thank you. John, how's things your way?
Man, it's been a fun week. Although it is Minnesota hot, it's not Texas hot, but it's been pretty sticky outside, and but still we're doing lots of outdoor activities and sweating through it and taking our kids on walks and stuff. So yeah, it's been a nice just week with the family, which I'm very thankful for.
We're headed to the beach this weekend, try to stay cool because it is humid.
Humid. Yeah, we got brother-in-law and his boys are coming over tonight, so I'm guessing they'll walk through the front door, give me a hug, and run right into the pool.
Yeah.
That's what they'll do.
Makes it all worth it.
Yeah. Yep.
Good stuff, guys. Well, this week we're talking about a modified endowment contract, what it is, and of course we're referring to Nelson Nash's book, Becoming Your Own Banker. And as we've been going through this book, we're on page 38 now. And just for us to kickstart the conversation here, a modified endowment contract is a status that the Internal Revenue Service, or the IRS, places on a life insurance policy to where it no longer maintains the preferential tax treatment that the policy could be designed for. And of course, our goal as producers, as agents, as practitioners is to make sure that your life insurance contract never becomes a MEC. You'll hear us use that acronym here in a little bit. Guys, what are your thoughts on modified endowment contracts, and what are some other key things that we want to pay attention to when we're designing policies?
Yeah, I think it's important to just look at the history behind that. And it's explained in Becoming Your Own Banker, and understanding that historically people loved life insurance, loved putting as much money as they possibly could into whole life policies, and whole life specifically, to have a safe place to store their money. And so understanding that in 1986, there were some tax changes under the Reagan administration, where lots of wealthy individuals who owned commercial real estate and some other assets, where some of the tax favorable treatments that they had in those assets were lost in 1986. What did they end up doing? They ran to life insurance, put as much money into life insurance at that time, single premium, I think at the time, if I'm not mistaken, where they just wanted a safe place to store their money that they knew would grow at a guarantee rate. And then the IRS and Congress and everybody who kind of wanted their revenue, right, for the government to continue funding what they fund. I'll leave it at that. And they saw that, wow, these guys are now treating life insurance as an investment. We have to do something about that. So in 1988, 2 years after that tax cut, in 1986, they created what's called this modified endowment contract, and basically said if you don't have proper balance between your premium and death benefit over a 7-year period, they call it the 7-pay test, then we're going to treat it as an investment and not as just standard life insurance that historically it's always been treated as. And again, this goes all the way back, like historically before even 1913, when income tax was created. Life insurance itself has had all the tax benefits that we now enjoy, with the one modification over the 200 plus years of its existence of this MEC, which still doesn't change the utility of whole life insurance for the banking function and for protecting your family. So I think just seeing that the wealthy individuals and the people who understood what they wanted to do with their money, they wanted a safe place to put their money, they all flocked to life insurance, is very telling of the security and the guarantees and the benefits that it provides.
Yep. Yeah, it's basically that 7-pay test, John. So you can't in any one year put in a deposit premium payment that would give you more death benefit than what you have the contract for. And so that's why they're always evaluating that 7-year, how many premiums are you putting in over 7 years to make sure that you are not putting in more than what you have death benefit to kind of hold it. So and one of the good things is the companies that we work with, they have tools put in place that automatically prevent us from designing policies that will MEC. And so, we put in our clients' requirements of what they want for premium or what they want for death benefit. And we put it in and see where it'll fall in terms of annual premium and death benefit. And if it exceeds that 7-pay test, it automatically flags it as a MEC. So that we know how to adjust it, so we can get under that MEC line and have a comfortable buffer there, go for future, so you don't get yourself in trouble down the road.
All right, so we know what to avoid. We want to avoid a modified endowment contract like the plague.
Yep.
How do we design the policy? What are some guidelines that Nelson prescribes here on page 38 of the book? What are some things that we as practitioners and people who are actively doing this with our own personal finances, what are some things that we wanted in our policies that we would encourage our listeners that they should pursue as well?
Well, I think it's helpful just to maybe back up or establish a foundation. And I do this for a lot of people I talk to, is just understanding the difference between base premium and PUA and kind of what the trade-offs are. There are no deals in life insurance. We've probably said that a ton of times already, and we're going to say it a ton of times in the future. And so there's just different levers you can pull. And so the base premium of a whole life insurance policy, and we're only talking about whole life in this case, that purchases death benefit for you. The cost or the what you're giving up in that case is early cash value, right? Because in the first few years, it's purchasing a death benefit, a permanent death benefit for the rest of your life. And that base premium typically is able to be paid out for a very long period of the policy. That's kind of the engine, right? That we refer to the base as. But you do sacrifice liquidity or access in cash value for those first 2 to 4 years, depending on how it's designed. Then there's the PUA, paid up addition, that does give you that early cash value. And the trade-off at that point is you have access to the cash that you put in, but it doesn't purchase lots of death benefit for you. So thinking about it in terms of a MEC, if you were to have 100% PUA, you wouldn't have enough death benefit to keep that balance of a MEC and it not being treated as an investment versus life insurance. So that's why we really do care about the base. We care about protection for families and protecting people's income should they die prematurely. But we also care about the banking function, obviously, and we want to include lots of room for you to store your capital and use it in the advantageous ways that's explained in Becoming Your Own Banker.
Yeah, so like what John was saying, basically the more base you have in the policy, the more cushion you have against that MEC line. So we want to design it with the right ratio of base to paid up additions rider so that you have that good kind of foundation of death benefit as part of the base, but then you have a correct ratio of paid up additions to give you some early cash value. So it's really, we just kind of work with our clients. How much death benefit do you want? How much can you afford? How much, so it's basically how much premium and death benefit. We kind of find that correct ratio of what they can afford and what they need. And then we design it so that it can be a useful long-term policy. Because you got to think long-term, as Nelson says, long-term policy that you can leverage over the years. Because when you look at the illustrations, and we've mentioned this before, the later years are when it gets really efficient. So that would be a shame if you have a really small base, high PUA. you literally can't put any more money into it in the later years other than the base, small amount of base. So then for every dollar you put in the later years, you're getting multiples of dollars back in death, cash value and death benefit. So it's a shame to basically, prevent yourself from taking advantage of that efficiency. So there's a really strong argument for having that correct ratio so you can continue to pay premium as long as possible to keep getting those multiple returns on your dollar. So there is a right ratio that we think is that right combination of cash and protection and buffer from the MEC line.
Hey, Rob, you're mentioning a timing of, how long should somebody pay premium for, right? And Nelson, of course, describes this, but he also has that graphic on page 38 that shows, hey, this modified endowment contract in an arrow of, potentially sneaking up to that MEC line. Nelson also says that the shorter the payment period, the better suited it is for the purposes of infinite banking. So how can those two things be true simultaneously? You wanting to build up wealth and capital inside a policy over many, many decades versus what Nelson's saying is a shorter payment period. Help us try to reconcile those two things.
Well, I personally, just from running illustrations and designing them, like I was just saying a minute ago, it's an opinion. And we work with, clients to, get what they want to do and then guide them in terms of keeping their policy correctly created to prevent them from, getting into MEC trouble. But I want to pay premiums as long as I can, especially in those later years, because it's so efficient and you're getting, for every $1 you're putting in, you're getting 20 back, and the later year or higher. I mean, it's crazy. So I personally want to design policies in such a way that I can keep putting premium as long as possible, because the return on your premiums in the later years are so big. Why would you not want to do that? So that's my counter to Nelson's kind of shorter pay period.
What would you say, Derek?
Yeah, I think, that if you were to only read that one line from Nelson's book here, you would say, well, of course I want a short payment period, like 10 or 7 years, or maybe even a single premium. But then Nelson also goes on and he says, well, wait a minute, when using this type of life insurance to solve your need for banking, it is best to select a plan that is in the middle of the scale, somewhere around life paid up at age 65 or ordinary life policy. So in an example here, life paid up at 65, what does that mean? Well, if you're 25 years old, that means that you will be paying premium until age 65. Once 65 hits, you no longer are required to pay premium to the insurance company. What about an ordinary life policy? This would be an example where you may be paying premium up to age 95 or even longer. The idea here is Nelson is saying, look, you want to be able to have a place to store your capital for many, many decades. I would urge at least 3 decades if possible, depending on the age of the client. I would say, let's think at least your working career. How many more years of working do you have? And then maybe even go beyond that. And of course, Nelson says that this needs to be done in conjunction with the paid up additions rider, which we can talk about here in a little bit. But what are your take on, you see that initial quote saying a short payment period, and then Nelson says, well, wait a minute, it should really be, something that's a couple of decades at least.
I think that speaks back to the 1988 kind of historically what people were doing. If you're looking at the scale on page 38, you see that it becomes a MEC on those single premiums. So for the banking purpose, for the immediate liquidity, for the less death benefit, that's probably what they were going for, is for the banking purposes only. But then zooming out and having a long-term approach to that, I think, his clarification that, between 65 and 100 years old of paying your premium until is more ideal because of that long-range thinking, because of the efficiency that Rob mentioned. And also, and this was a mental block or hurdle that I had to get over, is feeling like intimidated about paying premium until you're 95 years old, to me, it helped to think, X amount of dollars is going to feel so much less of a burden 30, 40, 50 years from now, right? I think Nelson Nash in his book, Building Your Warehouse of Wealth, he shows physical checks of dividends from a policy that he started in 1953 that I believe the annual premium was like $550. His salary, I think, was like 10K in 1953. So that was very significant to him. But any of us to think like I'm saving $500 a year, that's as bare minimum and as little commitment as you would probably hope to get. But that $500 annual premium was producing close to $5,000, almost 10 times in dividends. And I think it was written around 2018, if I'm not mistaken. So anyway, just thinking of that long-term growth, the dividends that come towards the later years, and being able to continue to pay that, and how much less of a burden that's going to feel over the long run, really helped me, and I think still does accomplish the banking function, and over time will really solve for that over multiple generations in establishing your family bank.
Yep.
Let's describe what a paid up additions rider is. Is it something that we do as a standard across the board, or is it kind of case by case scenario? How would you describe it, and when do we use it?
Well, paid up additions rider, it's a rider. So insurance policies have riders, like accelerated death benefit rider, premium rider, premium payment rider. So paid up additions rider is an option, a contractual option within your policy that allows you to buy, I call them like individual death benefit units. So over and above your base. So if your base is X amount, you have a contractual right. If it's designed in, that's what we do. We design that room, a contractual right to purchase paid up additional units of death benefit. And the moment you purchase a unit of death benefit, it's instantly paid up, and you instantly get the cash value of that paid up unit. And so that's what PUA is. So we have the base is this long-term contract where if you keep paying this base amount, you will eventually, over a long period of time, get this death benefit due to what you're paying on the base. The paid up additions rider, though, allows you to put in, to purchase units of death benefit right away that are fully paid up at that moment. So you get to fully realize the present cash value of those units. You can then leverage those in policy, as policy loans right away. So it gives you that nice blend of death benefit plus instant cash that you can then use for infinite banking in your family's life.
Another thing to add about PUAs, and this is a generality, not necessarily universal, but base premium is generally what produces dividends. For most policies, there are some out there that I've seen that have PUAs be the basis for a dividend. But generally, if you have very little base, you're probably going to minimize the amount of dividends that you're getting, especially up front and over the long term.
Mm-hmm.
Yeah, and with regard to the paid up additions rider, depending upon which life insurance carrier you were to design your policy with, they may have different features or different types of paid up additions rider. The one that I'm most familiar with has 3 different types of paid up additions. You could do a lump sum, maybe in the first 1 or 2 years of your policy, and you no longer required after that. You could do a level paid up additions, meaning it's going to stay the same, or you're going to have that contractual right for $10,000 and it's going to stay as a maximum of $10,000 for the life of the policy. And then there's another type where it's fixed, where it's more rigid and not necessarily required, but if you chose not to contribute for 2 or 3 years out of the life of the policy, then that rider would fall off and you'd no longer be able to contribute any more paid up additions. So there's a couple of different levers that we can pull and play with. but it is going to be something standard as we're designing policies for the purposes of banking, that we are going to include a paid up additions rider in your policy. You can guarantee that much.
I'd also quickly say though, there are cases where someone just might want a straight up death benefit policy. They want to maximize the amount of death benefit they can get, and they might not want a blend of base plus PUA. That's totally fine. Do that too. But typically when we're talking about infinite banking, well, almost always when we're talking about infinite banking, with the using whole life, it's always this combination of base plus paid up additions.
There's another scenario, guys, though. I mean, Nelson's describing how we design a policy for the purposes of banking, but that's not the only purpose or reason why somebody may want or need a life insurance policy. I think it's one of the primary reasons, but as we've seen, and it's becoming more popular, people are looking to these policies as a source of passive income in their retirement years. How does that change the conversation around the way we design a policy? What are some important features that we want to make sure that we're communicating and calculating?
Yeah, I think simply put, the lower the base, the generally less that you'll be able to take out in passive tax-free retirement income.
So in other words, John, you're saying that it's a good idea to have a significant allocation to the base premium relative to the overall premium that you would be paying. So let's give an example here. Let's say the overall premium was $20,000. How much of that do you think should be allocated to base? And, is it going to be dependent upon how much income that person may be planning on or forecasting these policy to potentially have access to?
Definitely. Yeah, it depends on their goals, maybe other assets that they have that they've already built. We just tailor it exactly to the client's needs and goals, and can pull different levers like we've talked about, and we can maximize that passive income in the later years. But again, that comes with trade-offs, which I don't think are very big costs, like upfront liquidity and some patience that's required. But yeah, absolutely. Just like you said, Derek, is just to have that right balance in order to achieve like the optimal result for your banking function, for your death benefit, for the passive income in later years, and any other needs that come to the surface. And I want to add just that, especially in my experience, any insurance person that I've interacted with and maybe done business with, it's kind of a fire and forget. You just purchase the insurance, auto policy, whatever it may be, and you kind of just go off on your happy ways and leave. Like, that is the beauty of what we get to do, is we don't just like leave. We are right there alongside, rooting for you, wanting to see you succeed. And if you have any questions, like as you can see, there's a lot of different aspects to these policies and to the use of it. We're right there with you, advocating for you to succeed for the next 20, 30, 40, 50 years, Lord willing, we can stay on this earth, to make sure you get the most out of your IBC policies. Yep.
And then also too, if you have come across our channel, you might be researching infinite banking. You'll run across other folks who are talking about really, really small base with really, really big PUA policies. And that's not what we do. We don't recommend that. We want to, we said earlier, we want to give you this cushion because we want to protect our clients. If you do a real small base, real big PUA, you get a lot of cash value up front, but you are really snuggling on that MEC line. And if you make any mistakes, anything, any kind of, the way you work with your policy, you might take too many policy loans out, or you might cash surrender. You could get yourself in a MEC situation really quickly. So for the protection of our clients, we like to get a healthier blend, more base, more PUA than base typically, but have a nice blend to get you that good balance of death benefit, cushion from the MEC line, and cash value.
Awesome. And guys, this section we've been talking about is mostly related to mutually owned whole life insurance. For the general public, however, they may not be familiar with different types of life insurance policies. Just to explain a little bit more, of course, there is your term insurance, which is by far the most popular, and what you will likely have as part of a life insurance policy through your employer would be either most likely a group term or a family term insurance plan. We've talked about whole life insurance. Now let's shift our focus a little bit, talk about universal life or variable life insurance policies. What are they? Are they designed? Are they built to sustain this practice of becoming your own banker?
I think those two are very enticing if you were to look at an illustration. There's another practitioner who we know and trust and respect. When he was in college in the 80s, when these products were first coming out, someone presented to him a universal life policy that said if you pay $20 a month, by the age of 70, you'll have $14 million in cash value. All you got to do is pay $20 a month. And it's just not true. It has general assumptions underlying in these policies that aren't guaranteed. I think there's power in guarantees that whole life provides that variable and universal doesn't provide. And so to back up, universal variable, they are annually renewing term insurance policies with like a side fund. I think, Nelson calls it a side fund, with a cash value fund that grows either based on, an index like the S&P or something like that, or based on stocks or mutual funds. That's the variable side of things. And the annual renewing term, if you're 20 years old, seems super cheap for the foreseeable future. But as you get older and older, you're more and more likely to die. So the term insurance every year gets very expensive. And by the time you're 70, even 80, it becomes unsustainable because that term portion of the overall policy just becomes way too expensive. Nobody's going to want to pay $20,000 a year for, a very little amount of death benefit that when you were 20, you were probably paying $30 for the same death benefit.
Yeah, let's talk about how it's tied to the stock market. A very common example would be an indexed universal life policy, which would be indexed very commonly to the S&P 500, which is the 500 largest publicly traded U.S. companies. Some things to note, the reason that a whole life insurance policy works so well for becoming your own banker is that there are guarantees, as John has described, and the dividends even are very steady and stable. The companies that we represent have paid those dividends out every year for 100 years. And when you're taking out a policy loan and you don't have a dividend that year to purchase more insurance, now you're dwindling that future cash value. The policy is going to have that drag on it. Even like an index universal life, if the stock market goes negative, maybe you make zero. The policy didn't earn anything that year. Whereas with a dividend from a whole life insurance company, which is much more steady and stable, that's almost becoming like a guarantee in many ways, where it's not guaranteed in the technical sense, but it's become so reliable that many people say that your policy is most likely going to perform very similar to the non-guaranteed dividend side of the illustration table. So when an IUL doesn't generate a return that year and the cost of insurance has gone up, now you're getting hit twice. And all of a sudden you thought, oh, maybe I could pull some income from this. Now you're really getting hit 3 times. The policies just generally don't last. And I've got an example of that. I have a family member who's owned a universal life policy for probably 30 plus years. And they just told me that their universal life policy is about to lapse, or they would have to pay more premium in order to keep it in force. So imagine this, they've paid premium for 30 years, and now all of a sudden that cash surrender value is down to $8,000 a year. I didn't ask this individual how much premium they paid, but I'm willing to bet you over 30 years, they probably paid more than $8,000 in premium. Mm-hmm. All this goes to show you is those policies, because of the annual renewable term and because of their lack of guarantees, the policies are not built to sustain banking or passive income, in my opinion. So that's why I would urge many people that have come to us and said, hey, you're talking about whole life insurance. I've got this other product over here. Well, there's a little known feature where you can do what's called a 1035 exchange, and you can exchange your universal life policy for a whole life policy. Basically, you're cashing out your universal life policy and rolling over those dollars into a whole life policy, which is built upon those guarantees and that reliability.
And the benefit of that, to clarify, is that you don't pay taxes on any of the gains in your former policy, if you had any gains.
Correct. Guys, any other thoughts or comments here for our listeners when they're thinking about, hey, these practitioners, how are they designing policies for us? Can we trust them? What are some features that they were going to want in their policies? What would you say to those listeners here as we wrap up this episode?
Well, all three of us. So that was, so Nelson was concerned about insurance agents using the idea of infinite banking as a marketing tool, and it is in a way, because it opens people's eyes to whole life in a way that they may have never heard about before. But what was happening is agents would just get a little nugget of what it is and then just go off and sell it. And so that's why they created the Nelson Nash Institute and the Infinite Banking Practitioners Program, which Derek and John and I are all members of. You apply to it. You're not guaranteed to get accepted. You apply, you get accepted. You go through rigorous training, many hours of videos and lectures and reading and tests and quizzes. Then you have a final exam you have to pass. Then you get paired up with a mentor, and your mentor, who is an IBC practitioner, has to then approve you, to become a practitioner. So long story short is, the Nelson Nash Institute takes it really seriously that we are know what infinite banking is, know how to design policies in the correct way to benefit our clients for their lifetime. This isn't just a marketing tool, a fire and forget. We get your policy and you never hear from us again. This is a relationship. And that's the whole point of it. We'll shepherd you through the journey of creating your family bank and building your policies, but we do it the right way to make sure that you're protected. And that is what our goal is. That's what that's what we want to do when we partner with you in this process. So that's I think the big takeaway of why you'd want to work with any infinite banking practitioner. Doesn't have to be us, but why you should seek out that kind of person who's been qualified, because I find you can, I don't know if you can agree or not, but all the practitioners I've met, their hearts are in the right place. They want to serve their clients. It's not a fire and forget. It's a relationship. And that's who you want in your corner when you are trying to get infinite banking started in your family.
Yeah, there's a lot to it. And we put in hundreds of hours of study and evaluation and running different numbers and understanding what each company can do for us, just so much kind of intense study that I know us three that we talk about, that we go through on a weekly basis, on a daily basis even. We practice this on our, in our daily lives. And, I plan on teaching my kids the exact same thing. So everything that we would be able to teach you, we're doing ourselves, and we're teaching our families to do the same. So it's, we love this stuff. It's pretty complicated, especially from the content that we talked through this episode. But we're just thrilled to be able to talk through that with all of our clients.
All right. Thanks, guys, for this episode. In next week's episode, we're going to move on to what I think one is the most exciting parts of the book, which is part 3, where we get to see some case studies and examples of how Nelson was utilizing his life insurance policies for the purposes of becoming his own banker And this is something that you can do too. And as well, we're going to be showcasing some modern day examples of this. And I hope that you will stay tuned to those future episodes. Please like, follow, subscribe, and share with your friends and family as we want to reach more and more people with this message of becoming your own banker. Guys, thank you again, and we'll see you in the next episode.
Good. See you guys.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.